sell your information to anyone.
All right. Yes, very well read. All right, let's see. So at the moment, we talked about the NASDAQ the other day. What was I? Let's see what I said about the NASDAQ. Must have been the other day. I think it was yesterday. You know, I wish I could remember all these days. Let's see. Tuesday, COVID cases. That's not about the NASDAQ. Monday, S&P. I don't know. It was either yesterday or Monday. I feel like it was yesterday, though. Control F, NAS. 10 times I said NASDAQ. NASDAQ, 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 NASDAQ. Haha. Here's where I worked it all out. Good. So, oh good, and it's updating itself now, I think. So that should be today's results. No, that does not look like today's result, does it? Because today's 5th. It should say the 5th on the calendar. Chart. Now, futures. NASDAQ. And the hourly chart should say the 5th. And we should be at 16,066. So this is annoying. Oh, I know why, because I have to do a capture. You can't, yeah, you can't copy these. You can, if you copy them, they don't pay, not that one. That one works. This chart, if I try to copy it, it doesn't work right. It comes up with a shit image. Here, look. See that? That's what happens. It's just junk. That's a problem. It didn't used to be like that. So when I have to copy these, I have to make an image capture of them, and then. But the problem with that is the old way they used to have it. I could copy the chart and it would automatically update, which I like. I prefer it that way. But anyway, so that's what's wrong with that. Where is it? Now I've lost it completely. Great. Yeah. Okay. So bottom line is that's where we were yesterday at 16.2. And what I was talking about was if 16, we won't be good if 16.2 can't hold. There's not real support until 15.6 other than the 16,000 line, but that's only because it's a round number. So where are we now? So now we failed 16.2, which is what we expected was going to happen. And by the way, you can do the balance charts because we said we were working off of 16.5, right? Even though it was a little bit high, but we were working off 16.5. But if you go 16.5 to 16.2, that's 300 points. And that means that you'll look, and this is an overshoot, you ignore that. You know, you look at the significant line. So you say 16.2 is 300 points. Then you would say, obviously, if it's, I hope it's obvious at this point, obviously a 300-point drop gives you a 20% retrace, which is 60 points. So that means you've got a weak bounce is 60 points, is 260. And a strong bounce is 120, is 320, sorry. So we never see what 320 is. Look at it, and look at how great the 5% rule is, right? Because there you are, you're right about, this is 16,320. That's the strong bounce line, totally rejected. And really 260 was generally the top, and see how these little, see how this guy and this guy touch it? So 260 is the weak bounce line. So you can see that generally, other than this quick attempt to make the strong bounce, you're basically failing on the weak bounce line. So you could almost tell it was going to happen anyway. And then down we go. And like I said, there's no support until we hit here. And that's not real support. That's just psychological support because the big round numbers always tend to be support. But we know, because we follow the NASDAQ, because when we watch the NASDAQ over the long term. And in the long term, what we know is the NASDAQ topped out at 5,000 and didn't even quite make 5,000. But the NASDAQ hit 5,000 in 2000. And then it didn't hit 5,000 again until it consolidated over here. But we do know that the NASDAQ moves in those five, the NASDAQ, it moves in 1250. Where's 1250? So NASDAQ's 1250. See that bottom? So it's 1250, 2500, and that's the top of this range and you're talking about like a decade of the range. So 1250 to 2500 is your range. Then we break up to 5,000 again and stop. And again, not quite even getting there, but we're plateauing just under 5,000, but that's good. That's solid because you're consolidating for a breakup. And how do you know you're consolidating for a breakup? Because you have small retraces, no serious pullback from the run from 2,500 to 5,000. So you know how much would the pullback be from 2,500 to 5,000 is 2,500 points. And that means that the retrace you'd be looking for would be 500 points, 20% of the run, back to 4,500. And then the next retrace would be 4,000. And if the 4,000 holds, if the strong retrace is holding, it means that you're holding the top of the zone, that you're consolidating on the upside. If the strong bounce line fails, that means you're consolidating at the bottom of the zone, possibly consolidating for a move down. So that's how you watch these things. So then the next stop is 7,500, which is right there. Oh, no, 7,590. All right, whatever. It looks like 80 is the only way you can get it. All right, so 7,500 is right about this line. Consolidation for a couple of years around that line. Then you're going to 10,000. There's no, now here's the thing. There's really no consolidation at 10,000. So effectively, even if you give 10,000 the floor, we have not had any serious consolidation along the way up. So, I mean, this thing is just, there's been no, no real proving of the base of the NASDAQ. And the valuations of the NASDAQ have gone completely crazy. You know, it's like the .com bubble, basically. It's getting to that range at this point. There's a really good article before. I'll show you that in a minute. But anyway, so when you go up this fast without a pullback, it's bad because you could very easily drop a huge portion of what you've gained. So anyway, we're aware of this. We're aware of the fact that 15,000, which is right here, was the closest thing we had to any consolidation. And we know 15,000 is a very significant line for the NASDAQ, but it hit 10,000 in 2020 and 15,000, 50% higher a year later. And now we're, you know, if this kept going, we'd be on a path to get to 20,000 this year. But that's insane. And that's the thing. I mean, at some point, it has to stop. There's a certain weight to the whole thing. So what I was talking about yesterday, as far as the bounces and the retrace lines, I said the bigger picture, just what I just showed you guys. That's why these webinars are good, though, because I can just show you what I'm doing live. And I said, if we're going to go to then, if we're going to 20,000, there should be consolidation at 15,000. We didn't have much of that. The week retrace from 20,000 would be back to 19. If you count the run from 15 to 20, 5,000 points, then a week retrace of that would be 1,000 points back, 19,000. The next retrace would be 18,000. So you want to start seeing, you want to see those zones come into play. They're not in play at all right now. We're nowhere near that. So 16,200 is a weak bounce from an attempt at 17,000. So that's where we're actually at now, 16,200, and 16.4 is a strong bounce. 16.6 clearly failed. I said if 16,000 is going to be a base, we expect to see the strong bounce lines of 16,240 hold, but it isn't. So now we look for a weak bounce at 16,120, and if not, then it's likely 16,000 will be support, or we're heading back. Oh, and we're heading back, I'm sorry. It's not likely 16,000 will be support, and we're heading back to major support at 15,000. And, well, okay. So in other words, if you count the run from, if you take the whole run from 10,000 to 16.5, that's 6,500 points. That means that you'd have a, 1350 pullback, and that takes you right back down to 15,000. So 15,000 is a very, very significant line on the NASDAQ, and that's probably where we're heading right now. It's just going to be a repricing of the NASDAQ at some point, and then that point may be very shortly. So anyway, so 16,120 was what we were looking for to fail. And get back to the hourly chart. And here's 16,120. So you see we had a little attempt at a consolidation here, but on the whole, we just plopped through. Maybe on the 5-minute you can see it better. Yeah. So here's 16,120. And you can see that happens. But see, the thing is, though, this is all today, and we were talking about this yesterday at 1 o'clock. I mean, that's how the 5% rule works. You can use it to predict what's going to happen tomorrow. Once you get used to like understanding what the math is, and again, it's not TA. I could care less about the chart. It's a math problem, because trading is almost totally done by computers, and the computers run on certain base. What's the word? There's certain parameters and basic algorithms that are going to go into a computer that are going to govern the way they work. Also, so what you've done is sort of digitize the way traders tend to think, and the traders will trade based on the TA guys aren't the ones usually programming the computers. I'm sorry, the TA guys aren't the ones programming the computers. It's mostly fundamental guys, chart guys, and then they're trying to just approximate what they should be doing, what humans think they should be doing in trading. But when they do that, they end up getting a very standard sort of set of parameters that we can easily track. That's what the 5% rule is. So then what I was talking about, there was a news article today. And you guys know I love to read. Of course, I don't remember the headline of the articles I read, but I know it's in here somewhere. La-da-da, Verizon scientist, Verizon Trump, crypto, Chrysler, gold, hidden bear market. Is this the one? I think it was. Yes, wonderful. Okay, so not the NASDAQ, but look at the S&P. He made a very good point. Look at these companies, 1, 2, 3, 4, 5 companies, $11 trillion of the S&P, 11 trillion out of 40 trillion. 25% of the S&P are these 5 companies. That's crazy. This is 495 companies. This is 5 companies. That's very messed up. So what he's saying, and the gist of what they're saying here, is that these top companies have an average return of 40%. They're adding all the market cap of the S&P. The rest of the index isn't really. The article's called a hidden bear market. The rest of the index isn't doing that great. So if you have all these different stocks, why are my stocks doing so great? You've got to be a very careful stock picker, which fortunately is what I love doing. But you got to be a very careful stock picker in this market. You can't just randomly buy stuff and expect to succeed, because there's a huge amount of stocks that are struggling at this point. There's 77 stocks in the S&P ended 2021 20% below their recent highs. That's a lot. That's 20% of the S&P basically is below its highs. Or below, 20% below their highs. 20% correction is considered becoming a bear market. You want to see consolidation. You want to see pullback. 129 stocks recorded new highs during January trading session versus 48 that registered new lows. So there's still things moving up. And the equal weight version of the S&P sports 1 unit returns and identical to its market weighted counterpoints. So they're basically just saying, don't be, if you're heavily invested, understand that you have that you're exposed to a niche in the stock market growth-oriented large US tech stocks are doing very well at the moment, but it could turn, and then you've got all your eggs in one basket. They need to be very careful because this is not good. And of course the S&P then drives the NASDAQ, drives the Dow, pulls other things along with it. Because everybody's like, well, the S&P's up 5%. We should be investing in the other indexes too. So that was very interesting. I thought it was a great point made in that article. Oh, this is cool too. Apple's this is the future. We're all going to look like this. That's how you're going to look. That's how we're going to look from now on. It's going to be kind of like a Borg or something. Continue without supporting. Yes, that's me. I'm continuing without supporting. But can you believe this? This is the future. Although, oh, no, wait. I don't want to jump around too much. But there was a monitor. Where was it? Oh, Samsung. Oh, this is totally cool. Look at that. That's Samsung's new projector TV. Oh, screw you. This is a 100-inch projection TV, $1,000. It's $895, I think it is. They said, and it's also the speaker. So it's your speaker, it's your projector. You can take all this around. So if you're going like on a trip or something like that, if you have another house and you want to have a big TV thing with you, this is fantastic. So I finally found what I want for Christmas, except I missed it. And what else was there? That's cool. Robots are going to be cool. What was the other thing I was looking for? That's a good article. China is uninvestable, which I agree with so much. Getting kind of scary over there. Population growth slowdown, very important to know. Oh, damn it. Now I forgot what it was I wanted to hear. Oh, well. Sorry, I lost the thread of what I was just saying. I know I was looking for something. It was really cool, and I can't remember what it was. But anyhow, that being said, oh, that's important. Let's talk about what we talked about today. See if we have any questions. No questions. Oil report. Neil wants to know about the oil report. Well, I mean, the gist of it was not very exciting. Oh, that's interesting. Hopefully somebody's going to get that. I don't think anybody's getting that. Hang on a minute. Oh. All right, hopefully that won't be too noisy. The washing machine. All right. So let's see. So overall today, well, let's make sure we're looking at the right one. December 31st, yes, that makes sense. Crude oil imports average 5.9, blah, blah, blah. Okay, inventories decreased by 2.1 million barrels. This is not much over the holiday. This is a holiday week. This is ended on New Year's Eve. So it included people traveling New Year's Eve, although not people who obviously fill up afterwards, but you're catching basically Christmas and New Year's in this thing. And we're at, so the whole drawer is 2.1 million barrels. Gasoline went down. Wait. Gasoline increased 10 million barrels? What? What? Hang on. That's not what I thought it was said before. Oh, it was 10. Wow. I didn't realize it was 10. That did not hit my radar. Well, that's ridiculous then. There's 10 million barrel build in gasoline, a 4 million barrel build in distillate. So it's not a good report. But that's why we added more shorts to the oil. But oil, see, I have 5 shorts now. They're down $4,000. So it's not particularly good. What is this crap? Why is that there? Oh, the average price is 77 something, 77.74, way down here. But I'm riding this out because it's bullshit. You know, I mean, there's a huge build in distillates and a huge build in gasoline with a small draw in oil. This is not a good report. This doesn't show a lot of demand. How's the S&P doing? S&P's up nicely. So yeah, that's not good. And so you know when you look at that and you say, you know, the other statistics, there's nothing special happened here. The SPR, there's a little bit of oil taken out of the SPR. All other oils went down 2 million. There's a slight draw there, but nothing that gets rid of the huge build. And on the whole, you went from 779 to 788. So there's 9 million more barrels from 1 week to the next. That's how do you say that's a good demand situation? 9 million. Okay, that's a half a day's total consumption added. So no, this is not a good inventory report. Oh, you look down here, you want to check to make sure if the inventory, if the imports and exports were steady, and they were pretty much. We're still exporting 3 million barrels a day. So we export 21 million barrels a week. An entire day of our consumption every week isn't really consumption, it's stuff we're exporting. We take in oil and we sell gasoline and stuff to other countries. But it gets counted as US consumption. So, you know, there's a whole false picture in the world of how much oil the US consumes, because it's a very weird thing to be a country that takes in 3 million barrels from other countries and then sells product to the other countries. We're like a refinery base for a lot of countries that don't have a very good refining system, that we ship them the finished products. What else? Nope, nothing else too exciting there. So you know, basically on the whole, the report is certainly nothing there's nothing here that indicates to me that oil should be up around $77, $78. That's just crazy. So we're betting against that maintaining itself. And on the S&P, like I said, we think the Nasdaq's going to break down. We'll see how it bounces, but on the whole, I think we're going to have a much bigger breakdown than what we've had so far. We'll see how that rolls along. What else is exciting? That's it. Not much going on, actually. I mean, still slow holiday trading. If we look over at, I always like to look at the S&P, the SPY, and check out the volumes. But see where we are, we came, you know, coming off of, like, look at these ridiculous numbers. So starting back here on December 20th, we dropped down to 60, you know, 70, 60, 60, can't even call that 60, 56, 47, 54, 55, 65, 72, 70. We're only just now starting to get back into a range, into a trading area where it's, at least you can say people are there. These are, you know, what these used to be, these were like half-day numbers 5 years ago. You know, if you saw this kind of number, you'd be like, okay, the markets must have closed at 1 o'clock. So it's really crazy. And it's not just because it's Christmas, because we have some horrific numbers. Look at all this. Look at November. Same crap. And this was look how long this period went with these crazy low numbers. All right. So here's 100,000 on October 6th. So for basically the entire month of October, you're barely cracking 60 all the way to Thanksgiving. All right. And what actually happens to the market in that time? So see what happened during that time? What happened from October until Thanksgiving with no volume? The S&P gained We went from 40, let's call it 43 to 47, about 10%. So the market gained 10% in incredibly, and look at the volume. That's when we gained 10%. When the volume came back, what happened? We pulled back half of it. Then the volume went way down here and we came back up. And then selling. See, it's all red, big red lines. One out of 1, 2, 3, 4, 5, 6. So 5 out of 6 of these big volume days are sale days. And then the volume dies again and the market goes up again. See the pattern? So in other words, when there's low volume, there's certain default buys because there's always money coming into the market. There's money coming in through 401k and IRAs, and every time people buy an ETF, the ETF buys something, buys all their stocks. There's corporate buybacks. That's another big part of the market that's automatic. So the default in low volume is if there's less volume, the variable is not the corporate buybacks. It's not your paycheck going into your 401k, right? That's just the same every week. You don't change it. In fact, you're not even allowed to change it from week to week. So the steady input is your 401ks, your IRAs, corporate buybacks. Those are all very steady inputs that go into the market. So there's a base of the market that's 100% buying at any given time. It's just always putting money into the market. So when you have low volume, the variable base, not the variable base, but what's above the base, the variable is a smaller percentage of the action. So even if it's heavily weighted one way or another, it's not going to have much effect. You're not going to be able to stop all the automatic buying that's in there. As the volume increases, there are more and more sellers showing up. And there's a certain amount of buyers that overwhelm in any low volume market. But when you get to a higher volume market, the sellers hit a point, and we decided that point was 120 million. At 120 million, you've wiped out all the buyers. So when you start seeing the volumes creep up towards 120 million, it's very bad for the market. And that's one way you can always tell by looking at if the volume's picking up. So when you see something basically going over here, when you see the volume spikes over this line, it's almost certainly going to be red, and you can see that. Look over this line. I mean, reds, lots of here's red. Every spike up, red. You don't see very many green spikes. That's a green coming off of 2 reds. Back here is now already a year ago. But at this point now. Keep that in mind, though. You're building low volume rallies, and they're undone by the higher volume. So if you have a sentiment shift, and a lot of people try to sell them. This is exactly what happened in 2009. There weren't any buyers. They didn't realize there weren't any buyers, and that's how you see things dropping like a rock, and that's how you see broker systems shutting down, because there's nobody bidding, there's nobody buying, and the sales start overwhelming the system. And more open up, and people say sell at limit, and there's not even selling at limit, nothing happens. And then you've seen those flash crashes because there's no buyers, and the sellers are saying, I want my stock sold. There's a certain amount of people who are going to put in market orders to sell, not limit orders. And the people who put in market orders and can't find a buyer are screwed, and that's how the prices start dropping like a rock. And that's why it's so critical to have good hedges. Because in this kind of market, that could happen any day for whatever reason. You could wake up and that could happen. If Evergrande goes bankrupt, not very likely because the government won't let it happen, the Chinese government. But if Evergrande suddenly declares bankruptcy for whatever reason, that would be catastrophic market meltdown, because you would have no idea which funding. See, it's the same thing as what happened in 2008. If something like that goes, if Evergrande with $308 billion worth of loans goes bankrupt, you don't really know who's affected by the loans. You don't know what paper went bankrupt. That's what happened in 2008. Is certain real estate firms or small banks went bankrupt, but you don't know who they owe money to. So it starts having rumors. And then all of a sudden you find out, oh, this one went bankrupt. And that means some of the rumors are true. And that means, and you know how that is. If you heard a rumor from somebody that, I can't remember the names of who went bankrupt. Anyway, if you heard a rumor that Ortani Bank is going bankrupt, and then it turns out to be true, then the guy tells you Citibank is next. You're like, oh God, he knew about Ortani, he must know about Citibank. It's not necessarily the same thing, but this is how these things spread, and people start panicking, and they start calling their broker and say, sell my Citi stock at any price. And that's really, when Lehman Brothers went bust, the key thing that happened when Lehman went bust is that it meant anybody could go bust, because nobody, Bear Stearns too. It's a matter of once these big names started going bust, now all of a sudden everybody's like piling out of Goldman Sachs and piling out of JP Morgan, because you don't know what's good. You don't know what's going to happen. As stupid as it was, as unfounded as it was, to get out of these banks, it's a lack of understanding. The people, and again, that goes back to my always thing that I bitch about, is don't invest in things you don't understand. Because people think, if you don't understand that JP Morgan is a completely different situation than Bear Stearns, because JP Morgan owns Chase, and Chase is a massive personal bank, and nothing was wrong with those kind of banks. There was nothing going on there. It was the ones who were speculating in paper, and also JP Morgan was too smart for that. I mean, they lost billions, but they didn't lose hundreds of billions or anything like that. I mean, AIG went bust. I mean, Jesus. But you never know. You never know you don't know who's been funding Evergrande. You don't know who's got the paper, who's holding that paper when they go bust. Who's got the worthless paper? And then, and of course, rising rates are going to cause countries to go bust again. That's going to happen. Certain countries won't be able to pay their debts. There's this whole QFS reset coming in the financial system, but I don't know how it's going to effectively wipe out the debts of these countries. I'm not sure it's going to actually work. So we'll see. I've got my sort of skeptical about whether or not this is going to work. This is the plan. The plan the world governments have right now is to basically reboot the financial system and effectively wipe out the debts. So they're just going to say, oh, well, forget it. We're going to start from scratch. So they're going to recast the internet. It won't affect America per se or Europe per se, but it affects. There's the international money system that's behind all the central banks. They're going to recast that money, create a unified system called QFS, Quantum Financial System, which is, you can tell it's bullshit just from the name. But they're going to set up this quantum financial system, and to me, quantum means like Schrodinger's financial. Like, it could be there or not there at any given time. But they're going to recast it and declare these assets of the world are this, and they're going to then use some of those assets to repay the debt with what they call off-ledger money and move it to the country. So they're going to make everybody whole. So the countries are going to default on their bonds, but the bonds will get paid back, and then the QFS will act like the central bank, like the Fed does, and just hold all the bad paper. And of course, no one's ever going to pay them back. So that'll be the end of it. So it's like a default without defaulting. That's the great plan they have to get everybody out of this debt crisis that we're in, which nobody likes to talk about, but it's choking. I mean, God forbid we actually have to pay this money back. It'd be crazy. I don't know. Well, let's see. I know how this will look when I do this, because I don't know how fast your screens resolve. But yeah, $29 trillion. And I said by this year we're going to be 32 trillion in debt, because I was expecting the stimulus was supposed to pass for $2 trillion. That's why we're not 32 trillion in debt yet, but we will be by the end of this year, be $32 trillion in debt. Tax revenue, $4 trillion. Government spending, where's government spending? Oh, here you go. I mean, do the math. Federal tax revenue, $4 trillion. Federal spending, $6.8 trillion. We have a $2.8 trillion deficit this year coming up. This number will go from 29 to 33 without the freaking $2 trillion spending bill. So how are we going to pay that back? How would you balance that? How do you get this number to not be $2.8 trillion? Well, you have to raise this number. If you want the deficit to go down, then you've got to raise the tax revenue. That means you have to raise the tax revenue by 75%. So are you going to pay 75% more taxes? No, you are not. Therefore, we will keep running a deficit. Are we? You know, I mean, or we could, I guess we could cut half of the government services. We can cut half of government spending, and that would be one way to do it, but that wouldn't be very good for the economy either. So we're just screwed. And that's why they're doing this. That's why they're doing this QFS thing. But it's going to be, I don't know. It seems like a very dangerous proposition to me. Jal says, how is Munger justifying Baba purchases, or is he buying in Hong Kong? He's buying it privately. He's not buying it through Berkshire, so he can do whatever he wants, basically. What do we not know about this trade? There's nothing I don't know about the trade. Alibaba is a perfectly good company. It's the Amazon of China, basically, and all you have to do is basically invest in it. It's not complicated. You know, if you want to own it, you just have to get over your prejudice of like not wanting to own a Chinese stock. People in China don't go, oh, I won't buy IBM. That's an American company. That's not how, that's not how they think. We are the idiots of the world. I mean, we look, Americans are like that all the time. We think anything in other countries is crap. We won't bank. You know, I'm dealing with these guys on a big financial transaction, and they won't work with banks that aren't top 10 banks. And when they say top 10 banks, they mean top 10 US banks. They don't even like Deutsche Bank. They don't even like Credit Suisse. You know, I mean, Deutsche Bank, of course, is a bunch of criminals, but that's beside the point. But they don't like Credit Suisse. And God forbid you say the PBOC, the Bank of China or something like that is involved. They're like, oh, we're out of here. That's not real. The Bank of Japan. They actually like, oh no, not the Bank of Japan. That's not a real bank. Yes, it is. It's just as real as any bank that we have. But people are like racist, basically, are economically racist, and they won't do business in other countries, and they think it's bad to own stock in other countries. The whole rest of the world doesn't have this attitude. Only America thinks America is the most important country in the world. I mean, the rest of the world is very happy to do business with other countries. They don't have this thing where they're, where nothing else exists outside of their sphere of influence. So, owning Alibaba, it's just again, it's very easy to chase Americans out of a stock. That's the thing. So they figured this out now, and they're going to milk it because they can get all the idiot Americans to dump all their Chinese stocks and take losses. And all the very patient people in other parts of the world are just holding on to the stock and saying, okay, let the Americans sell all their shares. No problem. We'll buy them back at the end. It's ridiculous. For what reason is Alibaba no good? Because they might get delisted in America because Americans are scared of Alibaba? Who cares? They just go trade in Hong Kong. They go trade on Shanghai. They don't give a crap. Do they need your money to be successful? No, not at all. And does it affect their business at all? No, absolutely not. In other words, like Amazon's not in China really. So if Amazon was banned in China, would the stock drop 30%? No, why would it? Why? Because it's an American company and we believe in Amazon and we don't care if China doesn't blah, blah, blah. That's that's the attitude we have about things. If it's an American company, we love it. If it's not an American company, we're willing to believe any crap rumor about it. So anyway, but again, it's up to you. It's not a thing. If you can get used to owning stocks in foreign countries, great. Oh, the other thing is, by the way, that your broker will discourage it because they don't want you to own stock in foreign countries. It's a pain in the ass to them. Most of them don't even do it. If you're in another country, though, they have to. How successful do you think an English brokerage is going to be if you can't buy stocks in France and Germany? You know, that would be ridiculous. If you can't buy Intel and IBM when you're in England, do you think people are going to want to use their brokerage? No, of course not. So they're all multinational. But in America, God forbid you want to trade on a foreign exchange. They act like you're from space. So Josh says, Viacom, please suggest a third leg. Okay, dude, in chat, okay, because I'm not going to specifically sit there and figure out trades. This is a webinar for lots of people, so I'm not going to specifically figure out how to fix a leg of your trade. I wish I had that kind of time, but I don't. All right. So what are we talking about today? Today, yes. So meanwhile, for people who do have time. So I wanted to talk about today the dividend portfolio because, you know, dividend stocks are generally protective stocks. A lot of them haven't really, you know, done that well comparatively over the past year. And you can set up this nice, very boring portfolio. Even now, I mean, you know, if we've done very well. We've made whoops. So we're up 104% in the past 2 years, basically, just a little bit over 2 years. The main reason we're up so much, though, because this portfolio is not really designed to be up this much, but the reason we're up so much is because when we had the crash, this portfolio was down 50% or around 50%. We took another $100,000 and put it into this portfolio. We took it from the short-term portfolio, which, of course, because of the crash, had a ridiculous amount of money. It had like $600,000 in it. So we took money out of the short-term portfolio, put it into this portfolio, and we bought a whole bunch of crap. So that was, you know, when the market tanked in 2020. So that was well timed for us. So basically, we doubled down when everything was went to shit. So we're left with a lot of good positions that have now recovered very nicely. And you should always have that, though. Like, you know, again, if you really should always have half your cash on the sidelines. As close as you can, try to have half your cash on the sidelines. If you have less than half your cash on the sidelines, you should be watching like a hawk to make sure there's no bad signs. But if you have half your cash on the sidelines and the market drops 50%, then one half of your money drops 50%. You still have 75% of your money because you had 50% on the sidelines, and now you can redeploy and buy another. You can double down by another 50%, and you still have, you know, and you can buy another 50% that's half off, and double up and move forward. So, you know, it's a wonderful thing when you have cash on the side and the market tanks. If you're heavily invested, 80% invested, 90% invested, the market tanks. No, you're screaming, and all you can do is cross your fingers and pray it recovers. So why would you ever want to put yourself in that position? It doesn't make sense, especially when using half of our cash, or in this case, 45%. We were 45% cash. So we're using 55% of our cash. And we're still gonna make on these 13 positions, we're still gonna make $150,000. So the total portfolio value is 408. Although we're only, like I said, though, you're only 225 of it is in the actual positions. But so on 408 over 2 years, we're gonna make 150 divided by 408 is 36.7%. That's exactly what we should be making. So the return on 400,000 is 36.7%. Now, in reality, we'll be adding more positions and doing more stuff over time, because the more on track this is, the more money we're willing to risk a bit more as it comes in, and we'll cash out certain things. You know, like for example, these Viacom short calls. No, I'm sorry, not the Viacom's, the Gileads. These Gilead short calls already made $4,000, and they're currently minus 13.13. So we could free up this position and then do something else to make another 5,000. So, and there's other ones that could be cashed out because they're pretty much fully in the money. And we just did. In fact, we just cashed out Pfizer last review. We cashed Pfizer out of this portfolio and dropped, $35,000, $40,000, whatever, into the portfolio, into the cash. That's how we set up to buy a new position. Right now, though, we're just waiting to see how the first quarter goes before we do anything drastic. Although ET, we just doubled down on in the Morning Post. That's Energy Transfer over here. We just doubled it down because, and why? Because it's about to expire. It's January. It's expiring in January. We have the $5 short calls. We could just let it go, but it's not that big of a position. It's only a $10,000 position. So we're going to double down and do it again because it made good money. We've already doubled our money on this position. Anyway, so I'm not going to read every single thing, but Energy Transfer, we added to it. Well, let's look down here, in fact, so Viacom, we expect to make all the money. Energy Transfer, these are just real mellow positions, though. We're not swinging for the fences here. Kraft Heinz going to make some more money. LYB is going to be another $13,000. And look, it's oh well. Now this is going to be annoying. I can't. How do I move this? Oh, there you go. Let's see if I can move it over here. Aha. Okay, so where are they? All right, so Lyondell. What's this 90-90? Oh yeah, so it's at 96. So it's in good shape. It's not risky because it's at 96. We sell the $90 calls. We sell the $90 puts. So we're willing to buy more if it goes lower, but we are willing to be called away at 90 as well. And the net then is 48 minus, what is that, 12. So it's about 36,000 is the net on the position. And if we're called away at 90, it's 45,000. That's pretty simple, right? So 45,000. So 36 turns into 45 at 90 on this position. And other than that, you're in it for the dividends. And dividends are $4,500 over the next 2 years in dividends. So it's not a big risk. I mean, look at where 90 is on the chart. Our goal is 90. We are not setting a very high goal here. These are low risk things. If the market goes down, if the market has a rough year, we're fine. All right, then we have Philip Morris. Which is going. Oh yeah, Philip Morris is going to make $15,000. If all goes well, but Philip Morris is set up to. Well, Altria is there now called, right? So here our goal is 47.50. So, and 47.50 has already been left in the dust. So we're giving ourselves time. It's going to, and 47.50 holds. We're going to collect $15,600. And the puts we sold are the 40 puts. They're way the hell down here. So it's a very low risk trade. We're not risking getting assigned really. And we know we're going to collect the dividend, which is $3,600. And the net of this entire position is, we started blah, blah, blah. We let ourselves close out net profit, blah, blah, blah. Okay, so we lowered our basis to $12,000. So with $12,000, well, oh, I'm sorry. And then I said, our real basis on this is $12,000. And that includes the puts and calls that we've sold and the dividends we've collected so far. And that's the key to this thing, is you whittle down your cost basis. And you have to think of this in terms of a retirement strategy, because only 2 years ago we started this, and our position of 500 shares of Altria, I think it's 500. Yeah, 500 shares of Altria that we originally bought for 46, which was what, $23,000, right? So over 2 years, we have whittled our cost basis down to $12,000. But that includes that's including selling the new 2024 puts and so on and so forth. So our cost basis is going to end up being $12,000 after just 2 years. And then we are going to have a call away with 15.6 in profits. But in reality, what's going to happen is every year we keep doing this. 2 years from now, we'll sell it again. And the cost basis, instead of saying 15.6 in profit, we're going to keep that in our back pocket, and we're going to knock the basis down to $6,000. And then 2 more years, which is 8 total years of a trade, we have to knock the cost basis down to 0. Now, what does that mean? That means that we have not collected any profit yet, and you know, you can, it's just a bookkeeping thing to say that, but we haven't, because we have collected dividends and cash has gone in our portfolio. But we haven't on the trade booked it as a profit yet. But what we do have is 500 shares of Altria that we paid nothing for, net 0. We have the 36,000 back in our portfolio, and we're still going to collect this kind of money on it every 2 years. And that's the whole point to this exercise, is that when you do this stuff, you're going to lower your cost basis. And once you lower, you know, the reason we track our lowered cost basis, eventually the money is freed up. That's why you have, you know, these positions. Ah, shit. There. Sorry. These $225,000 worth of positions, that's what's left in them now. The cash is on the sidelines. Almost all of the cash of these positions has been recovered at this point. So the cash can now be redeployed, and then you can double up the amount. So then the next 8-year cycle, we double up the amount, and we're collecting 2 sets of the same. And then the next 8 years, we have 3 sets of stock that we're collecting money on and 1 set of cash. But now the 3 sets of stock are going to throw so much cash into the portfolio that we can add 2 more sets the next year. And we're only talking about 8-year cycles. So it's 8 years, 16 years, 24 years. So 24 years from now, you can have a portfolio 5 times the size of what you started with, collecting these massive dividends. So in other words, effectively what that means is if you're pulling 20% a year, which we can easily do the way we run this, then you're basically giving so if you put 200,000 in now, your payout in 25 years is going to be 200,000 a year without touching the $1 million worth of stocks that you're going to have at that point. And that's why you do this stuff. It's a cautious, slow growth strategy, but it's really worth pursuing. It's something that you should always be running on the sideline in your portfolio, because even if you're rich, even if you have millions and millions of dollars, it's nice to have money just coming in on a regular basis that you don't have to touch. So in other words, if you have $10 million, let's say, and you take $2 million and put it into a strategy like this, in 25 years, you'll be collecting $2 million a year. That's 20% of your 10 million. So, you know, you run this strategy and you're going to be pulling $2 million a year without touching any of your other money. Not only that, but you'll have another $10 million worth of stocks from this strategy. So you have $10 million worth of stocks producing $2 million a year. You'll have all your freaking money back in the bank and ready to, and you'll just be minting it on a regular basis. This is a great, great strategy. It just starts off slowly. And of course it starts off slowly, because the point of the strategy is to just keep collecting those dividends and keep rolling the money back in. Then we have NLY, which is a REIT, and people are scared of the REITs because of the rising rates. And they're like, well, don't these guys borrow money? Yeah, of course they borrow money, but they also lend money. So it's good for them on the other side, and they know what they're doing. It's not like they haven't been through these things before. So everybody sells them off when the rates are rising. That's why I'm not only sticking with them, but I would get more aggressive on these guys if they actually go down any further. But as it stands, I'm like, well, I'm fine with our targets, because our targets were for much lower strikes. You know, we didn't buy them here, we bought them back here. down, down the same level they're at now. So, these are small, but it's, in other words, right now, so when it says net, that's what you can, right now, you can get in this trade for 12,355. It's going to make $5,000 in 2 years, 41.8% of the 12,355. I mean, that's perfectly fine. If you're going to collect a 32.50 dividend. And this, again, is the point, though. Think about this. 12,355, year one, right? In 2024, you'll have $5,000 back. So it goes down to 7,355. You do it again, exactly what we're doing here. You do it again. 2026, another 5,000 comes out, and you're down to $2,000. Basically, just the 2,355 would be left as an investment. And then the next year, you'll be plus 2,355. So what you'll have is you'll have all your money back. You'll have $2,500 in cash, and you'll still be collecting $5,000 a year doing the same, just the same thing, the same strategy with the dividends and so on and so forth. And that's it. So then that set is complete, and it's only 2028. So in 2028, you've actually completed your first set. You've gotten all the cash back, and now it's time to start investing in the next set. And by the way, though, we don't really wait. We start with small sets when we have a significant amount of money back. We take, like right now, we have half our money back. We're going to start with some small positions. We're going to start selling some puts to establish positions. So we're going to say, and we pick up, look, here we sold 5,000, here we sold 3,000, and we're saying I would love to own Viacom if I can buy 500 shares of Viacom for $32 less the $6 we collected on the short puts. So for $26, basically, I would be very happy to buy 500 shares of Viacom. That's all we're doing there is promising that. Same thing for Gilead. Gilead 57.50, sold it for $10. So for $47, I would like to buy 500 shares of Gilead too. And all we have to do is pick like 4 or 5 more companies where we want to do that. We'll put $20,000 in our pocket, cash, in exchange for promising to buy some stuff. That's all this is. It's very sensitive very sensible investing. We buy things that are low in the channel generally. That's where we like to get into stuff. We obviously look at the quality of the dividend, the likelihood it's going to continue, so on and so forth. But on one of these, I'll show you one of the ones down here. I took it because I think they're going to start paying it again. So VTRS has 43% upside. Dow Chemical, 129% upside. See, these guys are stupidly undervalued, and we were able to set up a nice fund spread for these guys, and it's got a massive upside, even though it's a dividend stock. Frontline, oh, it's Frontline, right. So Frontline doesn't pay a dividend right now, but they usually pay a dividend, and it's very likely they'll reinstate the dividend once they feel that their cash is balanced out again. Shipping rates are still really high. There's still supply bottlenecks and so on and so forth. I don't think that's going to end, so I think this is still a good place to be. And once they have the cash, they'll reinstate the dividend, and all of a sudden people are going to pile back into it. But they went out because they cut the dividend. And I'll show you Frontline. Where's the thing? Oops. So the market cap, look at the enterprise value. The enterprise value is 3.6 billion, and the market cap is 1.5. It's not even trading at half of enterprise value. So they've I mean, you got to look at the loans and all the stuff they have going on. But the bottom line is they're cyclical. They go up, they go down. They honestly has nothing to do with the year. Look how we did last year. They had a nice year last year, in fact. And this year we're losing $44 million. Now we're going to get back to profit. Now they get back to profit for a couple of years. If you're a $1.5 billion company and you're making $200 million a year, that's pretty freaking good. The question is, you don't know what they're going to do. You don't know whether it's going to be 155 or minus 265 or minus 8 or 140 or 413. But what you do know is if you look at this over time, you know, it's 4 minus, let's say this is 320 something. So 320, 420, 460, 480, 580, 635, 735. So 735, 1, 2, 3, 4, 5, 6. So 735 divided by 6 is about 100. You know, that is 100 and whatever. Probably 120. So at 120 million a year average, 1.5 billion is a very reasonable price. And yes, they took a big hit. They had to borrow money. They had an unexpected downturn in business that they weren't expecting. You know, an unexpected downturn they weren't expecting. You know what I mean? And that then puts them in a cautious mode where they decide to pull the dividend because the dividend costs a lot of money to distribute. So they pull the dividend, pay down this debt, get this bankruptcy risk more into the green, which will take them maybe a year or so. But then once they do that, they reinstate the dividend and everything is hunky-dory. And they project to be in good shape by next year. So, you know, it's a good bet sometimes to say, well, they usually, you know, people who stop paying dividends always fascinate me. So I'm always like, well, you know, how long are they really stopping for? But because they stop paying dividends, there are dividend funds that are forced to sell them just because they stop paying a dividend. Doesn't matter what the price is. It doesn't matter what the circumstances are. If they don't pay a dividend, they can't stay in a dividend fund. And that causes some crazy selling that has no business going on. Not to mention, as I always say, people do not understand cyclical companies anymore. People have no patience. They think a cyclical company means you should hold it, you know, you should buy it when it's down. I mean, they think that you should like bail on it when it's low and buy it when it's high. They chase it. Like US Steel is the best example of that. US Steel, everybody piles into it when it's up, and when it goes down, everybody sells it like it's going bankrupt, and it's neither. You should really do the opposite of what all these people are doing. So that's Frontline. Pets.com, you know, we're just waiting for that storm to pass. They do this once in a while. Every once in a while, people get excited about them and they spike up, and then they go back down. And people get excited and they spike up. So we're waiting to sell calls until they spike back up. When the next time they spike up, we'll sell calls. I could kick myself though. I blew this one. I didn't sell calls here because it went up and down so fast. We just didn't get around to it. But again, 129% upside potential on this one. AT&T, you know, and again, AT&T has been fine for 100 years. AT&T has paid a dividend for 100 years. AT&T has invested $100 billion in a 5G rollout that has already impacted their bottom line. And now that they're actually rolling out the 5G network, people are selling it. Well, not really, because not now, because look at this, another 5% today. Because people are realizing that this is coming. 5G is coming, and it's going to change a lot of stuff. You know, when broadband rolled out and everybody was like jumping in, for some reason when when fiber rolls out and everybody jumps in, this is like that. This is it's not like fiber. It's more like when broadband rolled out. This is like we're going effectively from telephone modems to broadband on this step, because that's how much faster 5G is going to be, supposedly. But if it's all it's cracked up to be, and it seems to be very successful in the countries that are rolling out so far, if it actually performs as it's supposed to perform, it's going to make a huge difference. Things are going to be so much faster. And that thing is going to, but you know what else it's going to do? It's going to make the metaverse more of a reality. I remember what it was. I remember now, it was a Samsung. No, it wasn't a Samsung thing. Shit, that's why. It was a weird company. Chrysler Gold, Bear, Samsung, Cloth Mass, not the robot, China Mobile. Maybe it didn't come through. IBM, China, Warren Buffett, California. Ugh. No, that's what it was. There is a new monitor. That's what I knew. See, it had nothing to do with anything else. There is a new monitor that looks like 3D. Like the monitor itself looks like 3D. It's really cool. And I don't know where that went. Oh, hang on. The center. Because, you know, we just had the Consumer Electronics Show. Oh, I'm so mad I didn't send it out. Let's see. 3D monitor CES. Barcode? That sounds right. Mopic Spotlight. Simulated reality. I don't know if it's this one. Wait,
YouTube videos showing
oh,
how
that's
to
crazy.
achieve similar effects with those reflectors.
This isn't the one though.
Also many after of the iPad.
No, that's cool too though. Anyway, it's a regular looking monitor, except it's not flat. It's kind of boxy, but it gives you like if you look at it, you can see like, it looks like it's a giant screen. It looks like a movie screen practically when you're looking at it, because you can see like inside it. Hard to explain, but it's very cool. Actually, I can't believe I don't know why I didn't save that. Anyway, all right, that was very cool. That was the coolest thing I saw from the CES. That was cool, and also the things that now they've made the seat backs in the plane so you can put your phone or your iPad on the seat back. They've got a holder so that when you're traveling, you can use your own screen, which is definitely nice because their screens generally suck. All right, let's see if we have any questions. I'm not going too long today, so. SG is asking about SoFi. I'm not, you know, I don't follow it really, but I do know people are kind of excited about this stuff. And I don't mind taking a look at it. So if you remind me in chat, I'm happy to like go over the fundamentals and see what they look like. But I have not taken any kind of deep look at SoFi. Tom says the market is diving. Oh, that's interesting. See, sometimes we should look at the markets when we're doing these things. Oh, wow. Oh, wow. See, oh, see that? There you go. Back to 45, which actually better than 45. This is lagging. That's a 66. So at this point, then I'm going to put a stop on two of these guys at 60, and if we go below 50, I'm going to drop the stop down to the 50s. So lock in. I mean, because we can probably pull about $3,000 off the table and still have two shorts. So I think that's the way to go. This one I know is going to, again, like I said, right now, I mean, you guys can have a way better basis than I do because we're at 78.36. We're at 78.36. I'm in for, I don't know why it's not showing me that. I'm in for a definitely worse number than that. I'm in around 77 something, 77.37 or something like that. So, or 77.77. I think 77.70, something like that. But anyway, so this is a great price to be short oil. If you want to wait for it to cross the 78 line and then use that as a stop so you're not risking much. But, you know, if these are tanking, then very likely oil is going to tank as well. So it's kind of a good time to get in. Holy crap, look at this. Oh, dear. What happened? Does anyone know what happened? Where's my news? Let's see. Oh, is it, I know Biden was talking about COVID or something. Was it COVID or was it January 6th? He was talking about something today. Oh, news. Latest news. Starwood Property, I don't think that's why. Fed policymakers prefer rate changes versus balance sheet actions to achieve their goals. Oh, it's the Fed minutes. Oh, there you go. That's what's doing it. So, oh my God, they told us they were going to start tightening. This is not news. See, this is the thing. You know, when I'm like incredulous at why the market's going up, I'm like, I know this. This isn't a surprise. I don't have to read the Fed minutes. They already said it at the statement. Powell had a whole press conference about this. Nobody believes it until they read the minutes. It's insane. So basically what they're saying is rate hikes. We know there's going to be rate hikes. We know they're going to wrap up the taper in March. Here, previously, December 15th, Fed members predict 3 rate hikes in 2022. It's exactly what they said. It's not surprising that oh, Jesus. It's not surprising that we're going down now. It's surprising that we didn't go down before. That's what's surprising. But you see, this is what I mean about the volume. So in other words, the minutes come out and headlines pop up, and all of a sudden, these freaking people who sleepwalked through whatever the hell happened last time through the last Fed meeting because they were busy with their holiday plans or whatever in the low volume markets, right? Now that they're back and the same news comes out 3 weeks later, they're like, oh my God, rate hikes. And they start selling. It's like, it's funny. Wow, 44. That is killer. Holy crap. Now you hope this is going to be support here. So we're very close to where we need to find some support. So in this case, though, I think in this case, I'm kind of in the take the money and run mode at this thing because this line's got to be some support. And where are we on the? Oh, and look at the Nasdaq is right down at 16,000, which is what we said would hold also. So if this isn't support, we got problems. So basically, I got 4 short here, 46. Wow. $46.46. I don't want to be too greedy. I want to get out at 45. No. Oh, son of a bitch! Stop doing that. Here we go. 1/2. Okay. So 1/2 at 45 and take advantage of this dip. And that'll give us a nice base. Then we'll be really high. And then if we give a comeback, we'll just buy some more shorts. And if not, still make plenty of money on the way down. And the oil just waiting for it to crash. All right, well, that was easy to figure out. I like it when it's easy. Now, you see, that's the thing, though. When the market starts falling, you want to figure out why is it falling. And then you say, because like I said, I knew this. We all knew this. They said it 3 weeks ago. It's not news. And, you know, one of the problems is you have all these algorithms that automatically sell based on keywords. And the keywords here were Fed rate tightening, blah, blah, blah. And they act like it's news. But then the same algorithms also generate headlines in all the financial press. And then people read it and go, and they start, you know, pulling their hair out. And all the Robin Hood people start selling everything they got. And it's crazy. But it's great because, you know, we're smarter than that. You know, we know how to make money on these things. Are Kazakhstan riots driving the price of Bitcoin? That's interesting. Oh, there we go. So now, see now, oh, it's kind of weird to read. So whatever. So now the 2 that are remaining have a $2,200 profit. And we locked in some of the gains. So in other words, I'm expecting a bounce off of here, and we'll see what happens. But I'm very happy. I mean, because we locked in a very nice profit. And now we don't have to worry about it anymore. So that's good. Oh, there's 78. Last chance to short before it all hits the fan. But anyway, so that's how you play the market. So back to this thing. So the bottom line here is even if you start with a new portfolio, I mean, it's 13 trades. 2 of them are just short puts. So there's actually 11 actual positions with $150,000 worth of upside against a base of 200 and whatever, against a 225 base. And actually, if you look up here, it's not even, oh, you can't look up there. If you look up here, dividend portfolio. Oh, look, 107 now. How do we make money today? That's interesting. What was I going to say? Oh yeah, if you look up here. So anyway, so if you look up here, we're not even using much margin, so it's actually really good because mostly because we have the positions and they're just covered calls, so it's not like it's not the kind of crazy stuff that we do in the other portfolios. So that's the key. I mean, just oh shit, look at this thing. Look at that. These are up 3 now. They just gained another $1,000. Crazy. And there's only 2 now. But yeah, I mean, that's everything I was told. Oh, and I guarantee the volume is picking up. Let's see. So everything we just talked about is actually happening. It's like you don't have to wait for the lesson to end itself. It's happening in real time. What were we going to look at? SPY on Yahoo, right? Yeah, here you go. So when we started the webinar, we were at 31 million, and now we're at 43 million. So, a nice pickup in trading in the last hour. So 1/3 of the day's volume just happened in the last hour, and this is, of course, for sure a lagging indicator. So I imagine you'll see a much better number today as people like freaking out about the Fed minutes. But by the way, these lines are what they call pivot points. And if you right-click on Thinkorswim and you go to Studies, and you say Add a Study, and you go to Trend Studies, and you go to P, and then down here is pivot points, and that's how you add it. So that's all you have to do. But it's my favorite. It's my favorite way to look at it because the pivot points are basically telling you statistically the probability of the movement of the index given the past X amount of days, however they calculate it. But it's a pretty good thing. It's really based on a kind of Fibonacci sort of retracements also, which I'm a fan of. So these pivot points will tell you what the movement should be, and this is called support 1, support 2, and resistance 1 and resistance 2, and it's not likely, statistically unlikely, that it's going to violate these. And you can see that based on the action, they widened it considerably today. There was a much wider range of possibility today than there was yesterday. Yesterday you had this small range, and now you have this much larger range. So the chance of something happening, which made sense with the Fed minutes coming up and so on and so forth, the chance of some large movement was there, and it could have been up or down. And very simply, I look at something like this morning, and I say, well, there's a chance of a big move. I don't see how it could possibly be up. I don't see anything on the calendar that tells me that anything's coming out, any information's coming out. There's not really any earnings right now. So what would move the market up versus what would move the market down? And like I was saying, the Fed minutes, we know what the Fed minutes are going to say. We're not idiots. We follow this crap all the time. So we know what the Fed minutes are going to say. And there's nothing good in them. There's nothing encouraging, nothing in the market. So what else do we watch? We watch the Russia situation in Ukraine. We watch China and if they're melting down or not. So Russia's still bad. China's still bad. The Trump crap's still bad, you know, the January 6th thing. Nothing is improving. Nothing is better. Omicron, and of course, COVID still bad. So what is there to go up about? Why would we be doing that? And that's why, again, when this happened this morning, I'm like, screw these guys. This is bullshit. You know, there's no reason for the move. Therefore, I'm going to stay short, even though it burned me, even though I'm still burned. I'm still burned by $2,500. But now we're getting back to where I started, which is why I said when we get back to 77 something, whatever it is, I want to get out and get back to 2 contracts short. Although honestly, after reading that oil report, I don't know if I do want to do that. But look at this baby. Look at that. And you see how it comes right to that line. That's so funny, right? And then that's where buyers kick in. Why do buyers kick in? Because they've got the same information you do. They're looking at the same charts you're looking at. They're using this study the same as you are. And they set their machines to buy when it hits S2. Where are you going to? Now, if you're telling a computer program, this is a problem. This is the flaw in having computer algorithms run your trading, because when you have to program the algorithm for something it's going to do in any and all situations, because computers don't think for themselves. They don't say, well, that's only because of the Fed minutes. The computer just does what it's supposed to do. So therefore, when the market does this, do this. When the market does that, do that. And when you generalize like this, you make a lot of mistakes. You know, it's like, you know, when a baseball player says step into, you know, if it's a curveball, step into it, right, or whatever. When take your foot and step into it slightly to hit the curveball. That's an instruction for a curveball. But what if the guy is throwing a kind of weird curveball? What if it's different than a normal curveball? What if it's faster? What if it's lower? You know, there's adjustments that a human being has to make based on, you know, it's like, yeah, there's a rule for hitting a curveball, but that doesn't mean every single time you do the exact same thing. That's what robots do. That's what algorithms do. And it's wrong a large enough percentage of the time. Not only that, though, but because there are people who know what those algorithms are programmed to do, they counter-program their trading to take advantage of that. There's flaws in the system that are taken advantage of. And if you're using that system and being a sheep and following along with the same system, then you get taken advantage of. You've got to think for yourself. You've got to understand the whys of the trade, not just following rules that are set by other people. The more people are following something, the worse it's probably going to be for you in the end. Oh, wow. That was a good exit, huh? I think I nailed that exit. So we'll see anyway. So if it goes down, and now the thing is, if it goes lower, I can always add 2 with a tight stop at 47.40, right? I can always use the 47.40 line and put a tight stop there, or put a tight stop right here. Well, obviously, if I regret that I sold those 2. Oh, see, now we have 7,000 profit for the day. So if I regret that I sold those 2, I can always come back in and short 2 more and just keep a tight stop on the 2. And what am I going to risk? $300, $400 of the thousands of the 7,000 we made? I'd rather be safe. I'd rather lock in my game so I can calmly talk about it right now than sit there and be staring at it trying to nail the exact turn. It doesn't work that way. You know, not only that, though, but sometimes things spike down so hard and fast and come back that you can't even make the trade. So now you look at what everyone else is doing. So the S&P is holding the pivot point so far. That's oil. Forget oil. What's the Russell doing? That's how much conviction I have. I don't even have to look at it. The Russell has failed its support line. The NASDAQ is coming towards support, and the Dow is still way over support. So if you wanted to make a short bet now, I'd go with the Dow, because they might get dragged down with everybody else. So if these supports fail, if that fails and that fails, if 2 or one's already failed. So if any other support fails, let's put it that way. Well, not any other, so it looks like it's going to be the S&P. So if the S&P did fail support, which it isn't so far, if the S&P failed support, then I would short the Dow and put a stop over here, because the Dow has fallen the least. So it has the most to catch up if things start turning worse. and is a nice clean line here that I can set a stop at. Oh, I never noticed that, a little gray thing. See that gray thing going? Like when I move my mouse ever so slightly and the gray thing follows it. I did not know it did that. That's weird. I guess because usually it's not, yeah. It goes by so quick if you're doing it fast. Never noticed that. But you see that bounce off a pivot point. It's essentially the same thing as the 5% rule. It's not, I mean, you know, they're not using the 5% rule. I made up the 5% rule. It's my rule. So so they're not using it, but that's what I've observed that computers tend to do. And that's what happens here. So effectively, you're going to get the same kind of action. You're going to be getting a bounce off the support because this support is being used by enough people who program enough computers with enough money behind them that they cause the pivot. It's a self-fulfilling prophecy. Because that's how the pivot is calculated, that's where people start putting in buy orders. And then you see whether or not it's a strong bounce or a weak bounce. And if it's a strong bounce, you're probably, the buyers are overcoming the sellers. And if it's not, and if the strong bounce fails, or especially if a weak bounce fails, then the sellers are still overcoming the buyers. And if you want to get really fancy about it, you can see if the volume is increasing or decreasing. And that would give you a clue too, because as we know, more volume means more selling. And why is that? Let's go back over that while we're talking about it. Because the base of the market, if everything else, if every human was dead, you would have machine buying, IRAs, 401ks, corporate buybacks. Every day, no matter what, people will earn money, get paychecks, and money goes into their IRAs and 401ks, and that money is then put into the market. There's very, very few people have an IRA or 401k that invest in an inverse ETF. They're almost all positive bets. And then corporate buybacks, of course, positive bets. They're buying back their own stock. Therefore, every day, you know, let's say arbitrarily, let's say 20 million trades are bullish to start the day. So first of all, that means if the whole day is only 60 million trades, and I'm talking about on SPY. So if the whole day there's only 60 million trades, there would have to be a very large amount of bearish people there just to be an even day. The imbalance, well, so it wouldn't be 20 million, obviously it'd be some smaller percentage. But there would have to be, you know, imagine the imbalance you'd have to have. You'd have to have, it had to be 40 million sellers and 20 million buyers with live people just to have a balance of zero. So it's certainly not that much. But you get the point. That's why when I say when you get to 120 million, then for sure you run out of buyers. That's what happens. So once your volume goes over 120 million, it's very unlikely you're getting a buying frenzy. It's almost certainly going to be a sell-off. And that's what's happening. All right, I gotta get going. I gotta be somewhere. So anyway, so that's kind of how this all comes together. So we started the day talking about this, and here it is. Volume picks up, sellers show up, no more buyers. You didn't earn more money today. You didn't all get bonuses and put it in your 401k. Companies didn't change their buyback plans overnight. Those are steady amounts. So when there's some news that causes people to sell, you're not going to get enough new buyers to step in to overcome the trade imbalance. And then at that point, the 5% rule kicks in, and we can start discovering where does it end? Where are we going to find these bounce points? You see this, but then you can do the calculation. This is the S&P. So let's just real quick. So take the S&P and we do a 5-minute chart on the S&P. No, that's not long enough. Hours. All right. So we say, okay, we've been at 4480. I'm not going to count 4800. It's too high. So 4480 is where we fell from. Now I can go to the 5-minute chart. I'm sorry, 4780. So saying we fell from 4780, and now we're at, we hit the pivot point here at 4740, let's say. So it's 40 points. So a 40-point drop means 20% bounces is 8 points. So 4748, and you see how we're at 4750? That is the weak bounce line. It's 4748. The strong bounce line is 8 more points up, so 56. is the strong bounce line. Well, that does not look good because what happened? So now we say, well, what happened at the strong bounce? We cut through that like paper. It had no support. So it does not seem likely that we're going to get back to the strong bounce line at 56. We're probably going to fail the weak bounce line at 47.48. And if we do that, it means we're heading even lower than where we are now. And we're only bouncing because we hit the pivot point, not because anything improved. And that's how you read it. That's how you look. That's how you look at the charts intraday while something's happening. How bad is this sell-off? How bad does it look? And you see from the Russell, they don't look like they're going to bounce at all. They're not improving. They blew this pivot point. And again, it's because pivot points aren't the be-all and end-all. There's a certain percentage of people who use the pivot point. Therefore, a certain percentage of programs are going to kick in at the pivot point. But that percentage of programs is not enough to overwhelm the amount of people who are selling. And therefore, they fail. And the pivot points fail. And the people who use pivot points go, I don't understand it. The pivot points fail. But they fail because your percentage of people who follow it aren't that great. What's great, and what do I use? The 50-day moving average, the 200-day moving average, because everybody looks at those. Those are the most followed indicators. So when those get hit, that's very serious. A 20-day moving average. Moving averages are used by most people who trade on technicals. So I'm going to use those as my basis, not necessarily the pivot, but the pivot does tell me where a certain subset of buyers is going to kick in, but then they fail. And here you go, boom, they're failing. Because it's not enough of a subset of buyers to give you proper support. And now we'll see how far down we go also. And again, it goes back to what I was saying about the NASDAQ. We're not going to get support, real support at 16,000. We're going to end up heading back to 15,000. This is another 1,000 points of dropping for the NASDAQ. And let's see, 300 points is 1.7%. So therefore, we're talking about another 5% drop from here. And that's where we are. So we'll see if I'm right. I'm very pleased that I've, we now are up to $8,000 for the day. So that's good. Oh, there we go, $8,000. So but now we're running at half speed. So now the remaining shares are only running at half speed. So these two shares to the left are up $5,000 from the open, and a certain percentage, and the other 3,000 got cashed. And but like I said, this is off the Fed minutes, and all we're doing is going back to where we should have been if people had paid attention to the Fed minutes in the first place. All right, so we'll follow up with this later, and we'll see where we end up. But have a nice day, everybody, and thanks for coming.